In this week's update, the seasonally weak week flips to the strongest 2 months of the year. Why the gains should continue, battery materials stocks still giving, and precious metals continue to confuse. My name is Garry Davis, and as always, this is general advice only in this video. And please remember to like and subscribe to the video. All right, let's start with the all-important market perspective, because really at the end of the day, that's all we've got, having a clear perspective, not getting drawn in by the misleading media. So US earnings season and the US economy is travelling along quite okay. The earnings coming through, I think there's about 190 of the S&P 500 stocks have reported, and earnings continue at above expectations at pretty much the highest rate that we typically see. So this earnings season is not losing any ground compared to what we've seen in the last 2 or 3 seasons. And the outlook statements from companies confirm a sound economy, and there's a 10% forecast gain into financial year 22 from analysts. So things are still ticking along quite nicely in the States, and there really isn't any evidence of slowdown, certainly as far as the results go. Now, buying the pullback has worked very nicely. We got a pullback in September, and that proved to be a very good opportunity to get into some great stocks, and we're going to look at a couple of those. Not that they're recommendations, they're just examples of what's going on in the market. And it's a little bit contrary to some of the commentary that you're probably reading. We're not seeing a lot of, the S&P is not going up because stocks are getting more and more expensive. In other words, the PE multiples continue to rise. There's a little bit of that in a couple of spots, but generally speaking, that's not the case. Prices are simply tracking earnings growth, which is what you want to see. And I'll show you a perfect example with Microsoft in just a minute. So this remains very much a stock picker's market, but you don't have to do anything fancy to make really excellent returns in most people's books. So let's take a look at an example to illustrate this. So this is Microsoft, and again, let me reinforce here, this is not a recommendation. I'm purely using this as an example, but it's a very important and very relevant example as to why the prices at the index level, so I'm talking about the S&P and the Dow Jones and the NASDAQ here, should continue to rise over time. Now, that doesn't mean they'll just continue to go up in a straight line. There will be some bigger corrections than what we've seen. So we saw about 5% in September. We've seen that a couple of times in the last 18 months, but it's been pretty sporadic. But I'm sure that there will be some larger corrections that will be brought on by something. But that'll only be a short-term interruption to the long-term trend. So I think the long-term trend remains to the upside. And the reason why, if you look at the earnings result for Microsoft, is a perfect example. So let's just step through it. The Q3 earnings came in at $2.27 versus an expected result of $2.06. Now, you've got to remember that there's 1,000 analysts, and that's not quite right, but you know what I mean. There's a lot of analysts that cover stocks like Microsoft and Apple, and so there shouldn't really be that much of a surprise. Yet Microsoft has come up with yet another surprise, which continues the trend of beating consensus estimates by anywhere between 10 and 24% if you look at the last 4 results. And the growth of the company is being driven very much by their cloud business, by gaming, and as a result of that, they're seeing an expansion in their operating margins as well. So it's a pretty good news story, and it's really hard to see, given the growth in cloud applications, how this is going to change. The 2-year average PE for Microsoft comes in at around about 35 times. Now, on the surface, you might think that's expensive, but let's go over here and look at the results. So the expected earnings for 2021 are at $8 a share. And at the moment, the fourth quarter would have to be significantly weaker than the other three for that not to occur. So it looks like $8 is going to get beaten. And then you can see the forward estimates for 2022, 23 and 24 ramping up to a bit over $13. And if the history over here about earnings beats counts for anything, then this $13.27 in a couple of years' time is probably too conservative. Now, if we look at the PEs, at the moment the stock trades on a PE of 41, but we all know that the market is pricing in where they think the earnings will be in 9 to 12 months. So you really should be looking at the 2022 PE multiple of around about 35. And that compares pretty favourably with the 2-year average. So it's pretty much about where it normally would be, despite the fact that it's moved from 285 to 330 in the last couple of weeks. And the PE ratios, if you look out a little bit further, come down into the mid 20s. Now, earnings growth is forecast, therefore, at an average of 19% compound over the next 3 years. And again, that's probably going to be a bit conservative. So when you look at it in total, you'd have to conclude that Microsoft is fully priced, but most good stocks always are. You know, there's hardly a really, really great long-term stock on the planet that's not consistently fully priced. So that's nothing unusual. So if you assume that the multiple is not going to contract, in other words, the market is not going to decide that Microsoft is too expensive and therefore cut the PE ratio, then the price really should just track earnings. And if earnings are growing at nearly 20% a year, then the price should grow at something like 20% a year over the long term. Now, there'll be ups and downs. The price will get ahead of itself. It'll pull back. It'll probably get below trend. So, there'll be volatility. But looking at the long-term trend, you'd have to say it's highly likely that the price of Microsoft will continue to increase at least around 20% a year. Now, if you then duplicate that across 50 to 100 major stocks, and we'll have a look at just a couple of others in a sec, you duplicate that, then what you end up with is sentiment that remains broadly positive, and dips in the market are going to be bought. Now, again, individual stocks will do all sorts of different things, and stocks that don't produce the results will get hit and hit very hard. So you do need to be selective and careful about what you buy. But in terms of the index getting, completely derailed and heading into a major correction, it's extremely difficult to see how that could happen unless there's just, some major event such as China deciding to move on Taiwan or something of that nature, in which case all bets are off. But putting that aside, you've got to say that the market outlook remains pretty positive. Now let's look at a few others. Now again, these are not recommendations. These are just examples to show you the trends. Look at Nvidia coming out of that dip. This was an ideal time to be buying into a stock like Nvidia if that's what you wanted to own. Let's look at Blackstone, which is one of the world's really good financial asset managers, expanding their business. Terrific opportunity in that dip, and it's advanced to new all-time highs. Let's look at Google. Pretty similar sort of trend. So you multiply that across all of these tech majors, and you have to conclude that the S&P is highly likely, and the Nasdaq highly likely, to remain buoyant for the foreseeable future. That's just that's just the reality of it. So be very careful what you listen to, and be very careful of the media that you consume, I guess is the message. Now the S&P was up 1.3% for the week. It was another new all-time high, and we've cracked through 4,600 points. So for the bears out there that have either been on the sidelines and are hating it, or are trying to short the market and are hating it, then you've just got to get on board. The index is going up. Keep it simple. Just go with the momentum. This was the best October in the US since 2015, so that's a pretty good achievement. Technology made a new all-time high, and so did consumer discretionary, and we'll look at both of those sectors in just a minute. The US dollar was higher to 94.12. 10-year yields edged up a bit higher to 1.56, and the VIX finished at 16.2. So let's start with a couple of spread charts as well, which are really important. So this is the Russell 1000 versus growth versus 1000 values. So the large caps, and you can see growth really starting to pick up now. The money is definitely pouring back into the growth sector relative to the value sector. This is the small caps, not quite as pronounced, but there's definitely a move now back into growth stocks, small cap growth stocks, and I'm certainly seeing that when you look through a few hundred charts. You're starting to see some of these names that did amazingly well in 2020 have done nothing but get smashed for the last 6 to 10 months. A few of them are now starting to show some green shoots on the charts. But this is the really important one: consumer discretionary as a ratio of consumer staples. Consumer discretionary is absolutely killing it now. Admittedly, Netflix is in this index, and I think Tesla is also in this index, and they're just off the charts. So that is helping this ratio significantly. But there's no question that this is a sign of a very robust sentiment. You can't argue against that. So that is where the sentiment sits in the US. And the important thing, if you're an Australian-only investor, is that US sentiment flows around the world. Other markets are going to have a relatively positive sentiment if that's what's happening in the US. Now let's just quickly look at technology. So technology set new all-time highs. This is a terrific long-term trend. You've got to go back to the dip we obviously saw, the crash we saw in start of 2020, but before that you've really got to go all the way back to the end of 2018, which was the 3-month period when the US Federal Reserve were talking about raising interest rates and reducing stimulus significantly, and the market hated that. So that is the long-term trend. Let's look at consumer discretionary, and it's killing consumer staples in relative terms, but also in absolute terms. This is a very, very powerful move. Just having a quick look at currencies. The US dollar was slipping, but it turned around fairly significantly on Friday, as you can see. But we're still yet to get through this 94.7 level. So still remains in a bit of limbo. And as a consequence, the Australian dollar has moved up and was actually a bit more resilient. So this is more about the strength in commodity prices. The Australian dollar has done better. So that's the setup of markets in the US. In Australia, our dollar, as we saw, went up, starting to head towards 75. The ASX 200 fell 1.2% across the week, with very concerted selling across the board on Friday. There weren't too many sectors that were spared on Friday. Now, how much of this was down to a possible shift by the RBA on interest rates is, I think there is some contribution there, the degree of which we will see in time, but it would appear on the basis of not what the RBA said last week, but what they did or didn't do. There could be a shift in their thinking and their outlook, and that has ramifications for a lot of stocks in the Australian top 200, that's for sure, and it's probably not a positive impact. So let's look at the ASX 200. You can see quite sharp selling on Friday. Be very interesting to see what happens tomorrow morning, given the very strong finish in the S&P on Friday night. We didn't actually look at the S&P, so I'll look quickly at that. So there's the S&P, new all-time highs, Thursday and Friday, closed on the high of the session, which is very positive. You can see that it gapped down on the open on Friday, but managed to close higher and close on the high of the session. So you don't get much more positive than that when the gap down on the open just gets bought and the market continues to rise throughout the session. It's a very positive tone. But if we look at the Australian market, the large cap miners are still struggling. This is XMJ. If we look at energy also starting to come off the boil again, despite the fact that oil prices have held up quite well. Finance also got hit on Friday, and there's healthcare, some selling in bit of selling in healthcare as well towards the end of the day on Friday. So that's what the Australian market looked like to finish the week. Just check on Bitcoin as well. So Bitcoin had a little minor breakout a couple of weeks ago. We've pulled back into the range, but we saw some strength again on Thursday and Friday. So Bitcoin, you'd have to say from a purely technical point of view, is looking positive. That's really all you can say about the Bitcoin chart at the moment, looking positive on balance. All right, we look at precious metals. Gold fell by $10 to $17.83. It's still really lurking around the top of the downtrending channel. So it makes it very difficult to call the direction of gold while it hangs up there. It hasn't broken out of that downtrending channel, but it's not falling to the bottom of the channel either. So that that's a bit of a neutral situation. GDX had started to lead the metal, but that's now flipped back again on Friday. So let's look at those charts. So look at gold first of all on a weekly, and you can see here's the downtrending channel. We're just hanging about the top of it, but not able to break above. So gold really needs to clear 1822, 1824 to have any sort of glimmer of positive turn, and then it needs to set a new short-term high. So it's about 1850. And then ultimately we've got to get up here above 1900 to start to look more positive. And that's what it looked like on a daily chart. Silver, not a whole lot different. And if we check in on GDX, you can see we were getting a more positive response from the stocks. They were doing a bit better than the metal, but Thursday and Friday, significant down, big gap on Friday, and looking pretty shaky again. So very difficult to call the precious metals market at the moment. Other commodities, copper edged up a bit and nickel was edging down a little bit. So not a lot of change there. When you look at the demand for extra nickel, just to meet battery demand, is well beyond anything that's ever been seen. So the nickel market, in terms of the demand and then the ability for supply to keep up, is moving very, very quickly, and you'd have to say is a pretty positive sort of outlook, both for pricing and also for volume for the nickel miners. Now crude oil steadied, was pretty much unchanged from the previous week at 83.5. And the path of least resistance for oil is up for the reasons that I talked about last week, and that is years and years of underinvestment, and the downward pressure that's trying to be applied on demand is just ending up with a demand which is not going down. It's not going up, but it's not going down, and supply is getting harder and harder to produce. So you'd have to think that higher oil prices are probably the way to go. There's the spot copper chart, spot nickel, so not a lot of change in either of those two. So just to wrap it up, and this was the first couple of lines here of what I said last week, because I just think it's an important point to reinforce. If you're worried about the next correction, then there's something that's not clear about your strategy or your thinking. You know, you're being led by what the media is feeding you. You're being led by, you know, our natural bias, which is when the market's been going up and up, it's natural to think, well, it can't keep doing that. You know, and I hear that all the time from different people. You know, the markets just can't keep rising. Well, of course it can. If earnings are going up and it's not ridiculously expensive, of course it can just keep going up. So you need to, you know, move away from sort of our natural inclination and certainly what the media is feeding you, and just get clear about what you're doing. And I think the Microsoft example is just such a relevant one to keep in mind, that there's absolutely no reason why the price of Microsoft can't continue to rise over time. And Microsoft has got lots of mates in the States. There's many companies that are in a similar position. So corrections, large and small, are really to be embraced. That's the important point. Now, you can't just go out and buy anything, because there's going to be plenty of stocks that are going to get absolutely smashed. So you've got to be selective, and you've got to exercise a bit of a degree of caution, and certainly a bit of an element of getting your timing right. You know, being patient and waiting for the dips. But the important thing is, sit down and think about what you want your portfolio to do for you in terms of return and volatility, and what you want that portfolio to look like. You know, this is not rocket science. And then just go out and do it. Buy those stocks, buy them at appropriate times. Just be clear about what you're doing and try and get all the junk out of your head. You know, this is not it's not a difficult task. It's a challenging task, but it's one where the steps are relatively straightforward. Now, portfolio analysts last week, we looked at lithium sector. We also looked at hydrogen, which is obviously getting plenty of airplay these days. So it was an interesting session in portfolio analysts last week. Anyone that hasn't taken the $1 2-week trial yet, I would recommend that you take a look at that. There's more information on our website. There's my email address, and I'll be back with you next Sunday. Cheers.